Assalamualaikum and good day everyone. Hello. Welcome to my channel. Today we are going to proceed with the learning of the preparation of the consolidated statement of profit or loss and other comprehensive income. And we are doing this for a simple group structure where it consists of a parent and its subsidiary, only one subsidiary, ROSE-FAR320. And we are going to do that together with also a consolidated statement of changes in equity, where we will be showing the extract of the retained profit and non-controlling interest column only. And that is for the sample final exam, July 2021, and this is for FAR320. FAR320, it can also be used for FAR560 as well. Right, let's look at the question. You have the statement of profit or loss, which is the standalone statement of profit or loss and other comprehensive income for these two companies, Orkid and ROSE. Orkid is the parent company and ROSE is the subsidiary company. And that was given to you. The year ended 31st of December 2020. And this is the reporting date. And this is also known as what you call current financial year end. So it's the reporting date. And if you're given there all the items in the what that involve revenue, income, expenses, and you are also given the statement of changes in equity. So your task is to combine this item and you need to eliminate the intercompany transaction or whatever item which are going to be excluded in the preparation of consolidated financial statement. Right, so here you are given there. So here you are given the information regarding the acquisition. So if you look at the information given here, you are informed that 80% of the ordinary shares were acquired in ROSE. So this is the subsidiary and this is the holding company. Right, and you are informed that was on 1st of July that you acquire only the ordinary shares. No information is telling you on the acquisition of this 6% non-cumulative preference share, nothing. So that implies that for this 6% preference share, there is no percentage being acquired by the holding company, and all is belong to the non-controlling shareholder. So it means that the non-controlling interest in the 6% preference share is 100%. And for the ordinary shares, you are informed it was 80%. So this gives you a control. And since 80% is considered as a control, the parent company Orkid need to prepare the consolidated financial statement to incorporate the result of ROSE, and that will be together as a single economic entity. Okay, right. So here is 80% and this is 20%. And if you look at the date of acquisition, the date of acquisition is in the prior period or prior year, because if you look at the date of reporting date of the current financial year end, it was 31st of December 2020, which is here. And this is 31st of December 19. This is 31st of December 18. This is the date that you acquire, which is date of acquisition, somewhere in the middle of the prior period. So you have acquired the company here for 6 months, and all together you have acquired the company for 2.5 years, because 2 years in 2018 and 2 years in 2019 and in 2020, and 6 months in 2018. So what matter is our current year. This is our current year, which is in between 1st of January 20 until 31st of December 20. So you're going to consolidate the revenue and expenses 100%, and there is no apportionment needed since you have acquired the company for more than a year or at least a year. So the revenue expenses will have to be consolidated by not trying to apportion that according to time period whatsoever, because that is only the case of where the acquisition is a mid-year acquisition, right, throughout the current period. But here it was happening somewhere in the prior period here 2018. Okay, done. So let us look at what we have here. That was the first information, and you're also given the accumulated losses. Accumulated losses, whatever item that you have come across on the date of acquisition, meaning that this is your pre-acquisition loss. So pre-acquisition balance, and that has to be also incorporated in the calculation of the retained profit brought forward later, right, for the purpose of showing that in the statement of changes in equity. Remember, we need to prepare these two statements, the statement of profit or loss and other comprehensive income. I've prepared the template. The non-controlling interest share of the profit for the year, or profit attributable to the non-controlling interest, the statement of changes in equity, or consolidated statement of changes in equity, actually showing these two columns. And you can see that I also put some workings column next to retained profit and next to non-controlling interest. And you also need to prepare this part, what is the working for the retained profit brought forward as per what you have here, statement of changes in equity, and also the non-controlling interest brought forward that you need to disclose as working 3. Okay, let's start. Okay, what you can do first is that you can do the combination of income and expenses. But what I'm going to do now is I will focus on the journal or the adjusting journal entry, so that you get more expert or you understand better this part. So I'm going to do number 2. Remember, we have already done the first part, which is to determine the percentage acquired for both ordinary and preference shares. Remember, the 6% non-cumulative preference shares is a share capital that falls under equity, but the point is it is not acquired by the parent. When it is not acquired by the parent, should the subsidiary company declare dividend, like in the case here, the dividend was declared 50,000 as interim dividend, and also the dividend was declared later, perhaps you will see for interim and preference, none of the dividend will belong to the parent. Everything will belong to the non-controlling shareholder, since parent does not acquire. Second information is regarding intercompany sales. If you read the question, ROSE, which is the subsidiary, is the seller that sold goods to Orkid. Orkid is the parent company. And 90,000 there is the intercompany sales, and they make profit of 20,000. And however, you are informed as at 31st of December 2020, half of the profit could not be realized. So therefore, that was due to unsold goods. So there are 2 entries that you need to pass before you can prepare your consolidated statement of profit or loss. Don't simply just remember what to add, what to minus. It's better for you to know the adjusting entry, because in the future you will also be learning on the preparation of consolidated statement of profit or loss together with the consolidated statement of financial position in one question. So better be prepared for the future as well, should you want to learn more on this topic, consolidated financial statement, in a situation where it is more advanced, right? Ours are just simple group structure, right? So there be intercompany sales here. We're talking about sales, so we need to remove the sale because these are intercompany transactions. It won't be reported in the consolidated financial statement. There be the sale and credit cost of sale. So when you do that, it will be reflected in the item here, right, which is in your workings that I have included here. But we'll be doing that later after we have done our unrealized profit. So the sales will have to be reduced by 200,000. Sorry, the sale have to be reduced by 90,000. So this is some typo here. Let me just correct you. The typo, it should be 90. Okay, so just replace that with 90 because the goods sold was 90. So that is 90. So 90,000. Next, after you have done that, you need to remove the unrealized profit because the half of the profit could not be realized. So half from this 90, half from the 20,000. Why 20,000? There is the profit, so there is 10,000. That will have to be removed, or will have to be adjusted in the cost of sale. So you're going to debit the cost of sale 10,000 because unrealized profit on closing inventory itself is in the cost of sale, and you need to go and eliminate them. So the inventories will be credited, inventories of the buyer. At the same time, you need to do that here. You can do it here now. You will have your figure. Your figure would be here. The figure would be the amount here, right? So intercompany sale. Right, next one. Next one, what we're going to do is we are going to have our things on unrealized profit. This will be adjusted here in the cost of sale. So your cost of sale will now be adjusted with the intercompany purchase, this 90,000, and unrealized profit, this one. So therefore, it makes up 1190. Let's go to the next one. The next one is item number 3. Included in the admin expenses of ROSE-FAR320 is 20,000 rental paid to Orkid. So this is actually intercompany expenses, which is to the point of view of ROSE. It is an intercompany expense, the subsidiary. But to the point of view of the parent, that was an intercompany income, rental income to be specific. So how do we adjust that? You are informed the amount is 20,000, but you have the information here saying that Orkid has not recorded the rental income. So therefore, what you would see is that you need to first record the rental income because that has been paid. So bank should be debited to the point of view of Orkid, and therefore you will credit the rental income. So when you credit the rental income, you will create one extra row, which is this rental income column, right? You will have that item, right? And at the same time, since this income that you receive from your subsidiary, you are Orkid, you receive from the subsidiary, ROSE, that income is an intercompany income. That income has to be eliminated. So you will go and debit the rental income, right, for the purpose of consolidation because this is intercompany transaction. And you will credit the admin expenses, since the question say that that is in the admin expenses, right? So that one is 20,000. So the impact would be here in the rental income, where you will see that the impact at first it was being included, but later it was being excluded. So it leaves nothing here. So nothing means no amount at all. And for the income that you have, you would see that first you have to add the amount, and then you have to go and remove the intercompany rental expense of an equal amount. Okay, let's look at the next one. Okay, now we move on to the next one, which is item number 4. Item number 4 is included in the investment income of Orkid Berhad is dividend received from ROSE. This is talking about intra-group dividend. So when you have intra-group dividend, that has to be eliminated because that is an intercompany transaction. So in your investment income, if you look at the question, it has included that 50,000 here has included some portion of intra-group dividend from the subsidiary. So for consolidation purpose, this 50,000 will have to remove the portion of dividend income that you receive from your subsidiary company. So therefore, what you need to do is you need to remove the portion. How? Go and debit investment income by the portion that you have earned. And remember, the dividend that has been declared for the ordinary dividend is 50. You acquire 80. So 50,000 times 80% will have to be removed. And when you remove 40,000. And that will be removed where? It will be removed from the dividend that ROSE will be reporting. So ROSE will not, sorry, I'm talking about Orkid, yeah? Orkid will not report the dividend that was received from ROSE. Okay, Orkid will just report dividend that are received from the outsider. So therefore, that one will have to be removed in the investment income here. You have it here, and that was what you remove. Now it becomes 50 plus 10, 60 is the total combination, and 40 is the intra-group dividend. So now you are left with 70,000. For the selling and distribution expenses, we can do it now. So I've done this, I've done this, I've done this. Sorry, not yet, that one. Okay, let me just erase that. I've done this part. Investment income. And now I'm trying to add up the selling and distribution. So this is what I'm doing, no adjustment. So just simply add. Okay. Next one. Next one is looking at the item number 5. Before the year end, Orkid and ROSE has proposed final preference dividend. So this one is item related to the statement of changes in equity, where later it will be disclosed. But the point is, we need to know that the dividend has been declared by Orkid and ROSE, which is declared here is an adjusting item, of course, and that were declared before year end. This is dividend that are being proposed of final preference dividend. So to ROSE, that will not be reflected in the retained profit column that you have here under the statement of changes in equity, because what you show here is only dividends that are being declared, either interim or preference dividend, either that was final dividends or interim dividend, the one of parent only. The dividend declared by subsidiary company will appear in the individual statement of changes in equity under retained profit column of the subsidiary. Right, so you won't show that dividend that were declared by ROSE here. What will be shown is that the portion that ROSE declare, but those that relates to the non-controlling interest. So the one that are declared by Orkid, which is 90 million. How do I get 90 million? 6%, which is the rate given here, times 3 million. It gives you 180,000. And you have declared before that 90,000. So you will declare the remaining preference dividend. And you can see my calculation here. 6% times 3 million minus 90. So you have 90K, right? So you will credit final preference dividend. So this will appear in the statement of changes in equity. where it will appear here, showing the adjustment, and it will appear here 90,000. And the same interim dividend that has been declared in the statement of changes in equity, this is preference. The preference dividend here is the final preference dividend, so it has to be included. And do not forget to include also the interim preference dividend here, interim preference dividend, because that relates to information number 5 as well, right? Since we are doing things for dividend, you will also notice that the subsidiary has a dividend as well, this part. So for the preference dividend, we have no shares in our subsidiary company since we do not acquire. If you can check here, we do not acquire. So all dividends that were declared here belongs to the non-controlling interest. So that dividend here, this one, will have to be reported here. Okay, it is reported here, and that will be reported at 60,000. Why 60,000? Everything belongs to the non-controlling shareholder. So this 100% is the non-controlling preference shareholder percentage, since none of that are being acquired. Same goes for the dividend that were declared in the subsidiary company somewhere here, which is the one declared by ROSE. You are not going to report all, you're just going to report what is the portion of the non-controlling interest, right? Because the one declared by the subsidiary, the whole amount or the total amount will be reported in its statement of changes in equity under retained profit when they do their standalone financial statement. So here we report the non-controlling interest share, which will be also 60,000. So meaning that this is first half, this is second half. So why 100%? Because the non-controlling interest is 100% for the preference shares, as there are no acquisition. Now, we move on to the next one, which is the number 6. Number 6 is intercompany sale of non-current asset, where ROSE, you can see here, ROSE is the subsidiary. So subsidiary is the seller. Dispose one of its motor vehicle non-current asset to Orkid. So if it's disposed to Orkid, that is an intercompany transaction. If it's disposed to other parties outside the group, that is not an intercompany transaction. So that was disposed as at a profit. So the cost disposed was not informed. That is no problem, because we are not preparing the consolidated statement of financial position. So for the profit that were earned here, it is not going to be realized, because you have the last sentence, motor vehicle is still with Orkid at the end of the year. So you need to go and adjust for the unrealized profit of the item there, because it has been included, this 10,000 here, it has been included here. So this one must be removed. So you need to go and remove that, right? You need to go and remove. When you remove, you need to go and debit the gain on disposal, because these are intercompany transaction. At the same time, it will involve some depreciation adjustment that will also impact your admin expenses. So let us look at that part. So you need to debit the gain with the profit, credit motor vehicle if this is prepared in the statement of financial position. But here when we debit gain, we are removing it from here, from our gain. And that one would be having no more figure here, because 10 minus 10 is none. So that gain will not be reported, because that gain is from an intercompany transaction. At the same time, you will have to show the depreciation adjustment. Depreciation adjustment that you will be showing is by adjusting the over provision of depreciation. So since it is over provided, the admin expenses needs to be reduced by how much? Take the unrealized profit divided by the remaining useful life of 2 years. Do that. You have 5,000. So debit the motor vehicle, credit admin expenses. Specifically, you are trying to reduce the over provision of depreciation, and I have done here. And that over provision of depreciation is how much? It is 5,000, and that was for motor vehicle. Over provision of depreciation 5. Right. Next, we will have to report our item as well in our statement, our non-controlling interest. I'll be doing that later. This will be reported again. The unrealized profit will be reported in the profit attributable to the non-controlling interest is together with the over provision. We'll be doing it here. You can see the working one here. Let us just settle the item in the consolidated statement of changes in equity. So what we will do is we are going to add this, and we are going to include that in our consolidated statement. No adjustment regarding interest because there are no debenture being acquired whatsoever. So there are no need for you to adjust. There are no information that asks you to do any adjustment on intercompany transaction. So the profit before tax will be this. The tax expense, simply add, no adjustment for deferred tax whatsoever. If you may come across that later, the profit for the year. And then this is the profit for the year that you will have to see how much is the split between the parent and the non-controlling interest. So what you will do is you are going to have working one to show the share of the non-controlling interest in the profit for the year. How do you do that? First, take the profit after tax. So the profit after tax is the one in the question, where it is here, 1680. So that here this is done already. All this we already taken into consideration. So now we are done with the statement of profit or loss. We are adding the profit after tax or profit for the year 1680. You need to do adjustment in the subsidiary's profit, meaning that whatever affecting the current year profit of the subsidiary. So remember, in the unrealized, in the first two adjustment, this adjustment, right? You will see that there are intercompany sale where ROSE is the seller. So where you have ROSE is the seller, the unrealized profit is incurred or has to be adjusted by ROSE. So this is ROSE unrealized profit, and you need to go and remove that unrealized profit. Go and remove that. 10,000, just like what you did here. That 10,000 here. This one will also be removed here. And then unrealized profit on motor vehicle. Unrealized profit on motor vehicle is the one that you did here, because the motor vehicle is still with Orkid, so the profit is unrealized. So how much is 20,000? Is 10,000 as well. It's the same thing, the same amount, but of different item. Next is the over provision, the 5K here, 5,000. That's the only adjustment. And now we are talking about the preference dividend. For preference dividend, if you can see, it is a non-cumulative preference dividend. For non-cumulative preference dividend, what you are going to include here would be what you have incurred in the during the year, which is 120,000. That 120,000 is as a result of the dividend that have been declared by the subsidiary. So remember earlier this dividend here that you have, let me check, take a different color for you. I'll take one color, one different color. I will take green. Okay, green is my choice today. So this is the item here, 60 plus the item that you declared here. ROSE declare here another 60, right? This 60. So here you have 120. So non-cumulative preference dividend, the one incurred in the current year, or more specifically, this is the one here. One, the item, these two items here. Okay, that two item. And then that is 120,000. So this 120,000, you need to show how much is the profit that is to the preference shareholder. Profit to the preference shareholder is just in the form of preference dividend. So preference shareholder will have the profit in the form of preference dividend, and here it is all 120,000, since none of it is acquired by the parent. So non-controlling interest for the preference shareholder is 100%, so that gives you 120,000. And this is the profit attributable to the equity holder of the parent, and that would be 1545. After you have take 1680 and you go and cast downwards, and therefore 20% is the non-controlling interest in the ordinary share, and the amount that is shared by the non-controlling shareholder would be 429. So this 429 would be shown here. 429. Okay, this is the amount that will be shown here, 429, and the amount here would be the difference between 3135 and 429. That is the amount shared by the parent. Okay, I'll put a different color. Okay, 706. Done with that. You don't have to go and have your total comprehensive income attributable to the parent or to the non-controlling interest, because in this question we stop at profit for the year. There are no other comprehensive income. So this amount that you calculated earlier, you can now prepare and put them in the statement of changes in equity. The profit that is related to the non-controlling interest will be shown here, and that would be the same figure here. So take this, bring it here, and the profit for the year related to the parent would be, right, 2706, which is the figure here. 2706, sorry. That is 2706. 2706, right? Next one is to just complete your statement. I'm going to finish off with the interim dividend. This interim dividend that you need to go and include in your statement of changes in equity would be the one that you just take from here. So which is the figure here, this one, the interim dividend. Yeah, not only the interim preference dividend, but also the interim ordinary. So interim ordinary, I will use a different color to highlight. I'll use a different highlighter. This is the one that is interim dividend, right? Next, you're going to put it here. So I will choose the same color as well for the ordinary dividend. And what you will show, yeah, I will show that figure here. But be careful with your non-controlling interest column. What you show in the non-controlling interest would be just the 20%. So that 20% means, if you have here that is 20% from 50,000. So let me just show the working here. The dividend that was declared is 50, right? So we take 50,000 times 20%, which is the percentage of the non-controlling interest in the ordinary share. So 50,000 times 20%, so 10,000. What you include here is the portion relating to the non-controlling interest. For the transfer to reserve, you will have to just take the one of the parent plus the one shared by the parent in the subsidiary. So the one of the parent for the transfer to the reserve, let me just highlight that again, this one, okay. Okay, that one it would be 80,000. This one, this 80,000, this 80,000 that you have, right? This one plus 50,000, this 50,000, and times 80% for this 50,000. And that is because that shows the parent share in the reserve transferred by the subsidiary. So you are going to show just the parent portion with nothing to be shown here, because the transfer of reserve by the subsidiary to the general reserve is going to be done in the standalone financial statement of the subsidiary. Now we go on doing the first row. I'm doing it last, if you notice. So you need to make sure that you get this figure. How do you get 800,000? Balance brought forward in the retained profit as at 1st of January. 20. Now you will have to put your parent, right? And then look at if there is any adjustment to the parent in the prior period that you need to adjust. None. So I just skip that part. You can always check your pro forma template or the format to see what should be included, what are the pro forma items to be included. Next one is the one in the subsidiary. Okay, 300,000 is the balance brought forward here, the one that you get here. This one, okay, in the statement of changes and equity of the subsidiary. Pre-acquisition loss is the one here, this one, and that is going to show you this amount that you need to add. You need to go and add them, plus pre-acquisition loss. Do not add the pre-acquisition profit, just add the pre-acquisition loss. That will give you the post-acquisition profit of 50,000. And that post-acquisition profit, you need to also check if there is any adjustment that you need to do, what adjustment that may have happened or may have happened, sorry, from the date of acquisition 1st of July 2018 up till 31st of December 2019. Should you have any adjustment? So should you have adjustment, like let's say unrealized profit that took place within that period, or maybe adjustment like over provision of depreciation, any under provision, but here none. So we take the 500,000 times 80% percentage held by the parent in the subsidiary company, 400,000. Now you have 800,000. So this 800,000 is the one that you will show here. Okay, that was working number 2. Now we go into working number 3, which is on the non-controlling interest brought forward on 1st of January 2020. The one that you will arrive later would be this figure, but we want to get this figure first. How? Here, number 1, since the company has the preference shares, I'm doing the preference shares first. So the preference shares here was 2 million. that 2 million is here, times 100% because the non-controlling interest is 100%, right? So you have 2 million. And then you need to go and find your fair value of net asset. Fair value of net asset, 1st of January 2020. You only have 2 items in your fair value of net asset on that date. One is the ordinary shares, which does not change. Ordinary shares in the subsidiary company was 3 million. Another one is the retained profit brought forward, is 300,000. So the total is 3.3. That 3.3, there are no other adjustment that needs to be done. None. Therefore, you will have the total figure of 3.3 million. That 3.3 million will have to be multiplied with the percentage attributable to the non-controlling interest. So that is what you're going to do. Find the portion attributable to non-controlling interest. That would be this. Okay, you are done with that. You have 660 here, time plus 2 million. So you have 2660, and this 2660, 2.66 million, transfer it here. And then you can cast down, and you will see that that is 29593156. That's it. I'll see you when I will see you. Remember, you need to complete this question within less than 50 minutes if possible. I'm doing that within 41 minutes. See you when I will see you. And thank you for watching, and all the best for your final exam.